Okay, so you plan to own a space company. You're picturing rockets, explosive launches, roaring engines, the whole Hollywood image. Here's the twist. Almost nobody outside the industry knows. The rockets are basically the least profitable part of the entire business. And one of the biggest space companies on Earth just accidentally proved it. In public, in a legal filing they couldn't hide it in. Keep that in mind. It's about to explain almost everything else in this video. Here's the real question. If launching rockets is this expensive, this dangerous, this likely to end in a literal explosion on a launch pad, how does this industry pull in hundreds of billions of dollars a year? The answer isn't the rocket. It's what you do once you're already up there. In 2026, the industry's biggest player filed paperwork to go public. And buried inside that filing was a number that shocked people who'd spent years assuming rockets were the business. Their rocket and launch division, about $4.1 billion in revenue for the entire previous year. Their satellite internet subscription service, $11.4 billion, 61% of total revenue, and the only division actually turning a profit. Let that sit for a second. The company famous worldwide for building rockets makes most of its actual money from people paying a monthly internet bill. The rockets aren't the business, they're the delivery truck. So here's the real structure of this industry, and it splits into two completely different games. Game 1, build and sell the rocket, the launch, the ride to orbit. Game 2, own something valuable enough once you're up there that people pay you every single month for access to it. Almost every space company that's ever gone broke because they were only playing Game 1. Let's talk about what Game 1 actually costs, because it's brutal. Developing a new orbital rocket from scratch runs into the billions before a single successful launch. Even after that, a single expendable rocket, the kind you use once and throw away, costs tens of millions of dollars to build and fly. Which is exactly why reusability became the single biggest lever in this entire industry. Before reusability even matters, there's a cost sitting underneath everything else: talent. Aerospace engineering is a genuinely small, specialized labor pool. Propulsion engineers, avionics specialists, people who can certify hardware to survive launch stress and orbital vacuum, none of that is a skill set you hire quickly or cheaply. Salaries in this field run well above general engineering averages, and the talent pool is small enough that companies frequently poach senior staff directly from each other rather than train from scratch. For a new entrant, this means the very first hires before a single rocket component gets built already represent a serious ongoing burn rate. It's a cost most business breakdowns skip entirely because it doesn't show up as a dramatic explosion on a launch pad. It just quietly determines whether a company can execute on its own engineering roadmap at all. It's worth remembering how recent all of this actually is, because it changes how you should think about the risk involved. For most of the history of spaceflight, orbit was something only governments could afford to reach. NASA and a handful of other national space agencies were effectively the only customers and the only operators, funded directly by taxpayers with no requirement to ever turn a profit. The shift toward private, commercially owned launch companies is barely 2 decades old in any serious sense, which means every single business model discussed in this video, the internalization strategy, the subscription-shaped satellite services, the reusability economics, has been figured out largely through trial, error, and in Virgin Orbit's case, outright failure in real time with real money rather than inherited from decades of established industry playbooks the way an industry like radio or funeral homes can draw on. That's part of what makes this such a genuinely volatile business to enter today. Nobody in this industry, including the companies currently winning, has more than about 20 years of commercial precedent to actually learn from. A rocket that lands itself and flies again isn't just cool to watch. It's the difference between manufacturing a new multi-million-dollar vehicle for every flight and refueling one you already built. By 2024, the industry leader had pushed booster turnaround time down to 25 to 30 days. In 2023, that same number was 40 to 45 days. That's not a small improvement. That's roughly doubling how many times a year the exact same piece of hardware can fly. And that one operational detail is estimated to cut costs by 50 to 70% compared to competitors still throwing rockets away after one use. 50 to 70% on the single largest cost in the entire business. Now, revenue, and this is where Game 1 and Game 2 really start to diverge. Commercial third parties, satellite operators who don't own their own rockets, pay market rate to launch. Depending on the provider, that's $67 to $130 million per mission. But here's the part that actually explains why the biggest player in this industry dominates so completely. When you own your own rockets and you're launching your own satellites, you don't pay that market rate at all. You capture it internally. Sound familiar? It's the exact same internalization principle we covered in the waste management video, just running on rocket fuel instead of garbage trucks. Whoever owns the infrastructure captures the margin. Whoever rents it pays the markup. Government contracts are their own separate category entirely, and they don't work like commercial pricing at all. NASA and Department of Defense missions get priced through cost-plus or fixed-price government contracts, an entirely different negotiation than a commercial satellite company simply paying list price. Winning these contracts requires security clearances, compliance infrastructure, and a track record most startups in this industry simply don't have yet. There's a philosophy shift worth understanding too, because it changes how you should even interpret a rocket blowing up on camera. For decades, the traditional aerospace approach was to simulate and calculate everything extensively before ever testing hardware, since a single physical test was enormously expensive. The newer approach, favored by some of today's fastest-moving companies, deliberately builds and launches early prototypes, expecting some of them to fail, treating each explosion as a data gathering exercise rather than a catastrophe. This sounds reckless from the outside. Financially, it can actually be cheaper. A simulation-heavy program can spend years and hundreds of millions of dollars discovering a flaw that a real test would have revealed in an afternoon for the cost of one prototype vehicle. The rockets that blow up on video aren't necessarily failures in the traditional sense. Sometimes they're the cheapest form of information a company can buy. Then there's Game 2, the actual profit engine. And this is worth understanding in detail because it's not intuitive at all. A satellite internet constellation works nothing like a single rocket launch. You build it once, expensively, and then it behaves like a subscription business. Recurring monthly revenue. Margins that improve as more customers get added onto infrastructure that's already built and already in orbit. The numbers back this up dramatically. That same satellite internet division running at operating margins near 39%. Adjusted EBITDA over $7 billion. Compare that to the rocket division hovering near break-even in the same year. One division behaves like software, the other behaves like a capital-intensive nightmare that occasionally explodes on camera. Now, a real story about what happens when a company only ever plays Game 1 with no subscription safety net underneath it. Virgin Orbit. Richard Branson's satellite launch company spun out of Virgin Galactic in 2017. Their approach was genuinely clever. Instead of launching from a traditional pad, they dropped rockets from a modified Boeing 747 mid-flight, nicknamed Cosmic Girl, January 2023. Their sixth mission, the first ever orbital launch attempt out of the United Kingdom. Genuine history in the making. The rocket failed to reach orbit. The payload, including defense-related research satellites, plunged straight into the ocean. That single failure was the beginning of the end. Investors got spooked. Funding conversations that had been progressing suddenly stalled. By March, the company paused all operations entirely, trying to conserve whatever cash it had left. Then came the layoffs. 675 employees. 85% of the entire company gone in a single announcement. Branson's own investment arm threw in $31.6 million just to keep the lights on long enough to find a buyer. It wasn't enough. April 4th, 2023, Chapter 11, bankruptcy, court filings listed $243 million in assets against $153.5 million in debt. The company had burned through over $1 billion total in just 5 years, chasing a business model that depended entirely on rockets working perfectly over and over with no recurring revenue underneath to cushion a single bad month. One rocket, one failed mission, one entire company gone. That's the risk profile of Game 1, played alone with nothing else backing it up. And Virgin Orbit isn't the exception. It's closer to the pattern. Dozens of well-funded launch startups have entered this industry chasing the same dream, and the overwhelming majority never reach consistent commercial launch cadence at all. Some run out of funding before their first successful orbital flight. Others manage one or two successful missions and then can't raise the next round fast enough to survive a single failure afterward. The handful of companies people actually recognize by name survived a brutal filtering process most competitors simply didn't. For every launch company whose rockets you've seen on the news, there are several more you've never heard of because they folded quietly before ever making it that far. Compare that to the industry's other major public player, a smaller rocket company that's been public for years and still hasn't cracked the code. Recent guidance, revenue in the range of $95 to $105 million for a quarter, non-GAAP gross margins around 30%, and still posting an adjusted EBITDA loss, $23 to $27 million in the same quarter. Years of operating history, real contracts, real launches, still losing money on an adjusted basis. That's how unforgiving Game 1 is without a Game 2 business layered on top of it. Now, the regulatory layer, because rockets are legally treated almost like weapons, and that's not an exaggeration. Launch vehicles and their underlying technology fall under international traffic in arms regulations, the same export control framework that governs military hardware. That means hiring foreign engineers, sharing technical data internationally, even certain conversations at industry conferences can trigger federal compliance requirements most industries never have to think about at all. On top of that, every single launch needs FAA licensing, environmental review, and airspace coordination, sometimes shutting down enormous sections of sky and ocean just for a single flight window measured in minutes. There's a cost most people never think about at all, and it's enormous: insurance. Launch insurance covers the vehicle, the payload, and third-party liability if debris comes down somewhere it shouldn't. Premiums get priced against a rocket's actual track record, meaning a brand new vehicle with zero flight history can carry insurance costs that eat deep into a mission's entire budget, purely because nobody's proven yet that it reliably works. Fly successfully enough times in a row, and that premium drops. Fail once, publicly, the way Virgin Orbit did, and it can spike right back up overnight on every future mission, not just the one that failed. And once you're actually up there, a new cost shows up that didn't exist for this industry a generation ago: collision risk. Low Earth orbit is getting crowded, genuinely crowded. Thousands of active satellites plus decades of accumulated debris, all moving at roughly 17,000 miles an hour. A collision doesn't just destroy one satellite, it creates hundreds of new fragments, each one now a threat to everything else sharing that same orbital band. A slow motion hazard some researchers have warned could eventually make certain orbital altitudes unusable altogether if left unmanaged. An outcome with a name of its own: Kessler syndrome, a cascading chain reaction of collisions with no clean way to reverse it once it truly gets started. This has created an entirely new sub-industry: in-orbit servicing. Companies now specialize in satellite refueling, repositioning, and controlled deorbiting, essentially a tow truck and maintenance crew for space. It's a small niche today. But as orbit gets more crowded and satellites get more expensive, paying someone to extend a satellite's working life rather than launching an entirely new one starts looking like the more economical bet. It's the same logic as owning a fleet of trucks instead of buying a new one every time an engine needs work, except the mechanic has to match your orbital velocity first. So here's the actual size of the prize everyone's fighting over. There's a genuinely uncomfortable strategic reality sitting underneath all of this too, worth naming directly. When one company ends up handling the overwhelming majority of a country's launch capacity, that's not just a business success story. It's a national security dependency. Government satellites, defense communications, even parts of scientific research infrastructure end up relying on a small handful of private companies, sometimes effectively just one, to physically reach orbit at all. This creates a strange dynamic where the government is simultaneously the industry's biggest regulator and one of its most dependent customers. A prolonged grounding of one company's rockets, whether from a safety investigation or a manufacturing problem, doesn't just hurt that company's stock price. It can directly delay national security missions with no immediate backup provider capable of stepping in at the same scale. It's part of why so much government money has quietly flowed toward funding a second and third viable launch provider over the years, not because they were expected to be more efficient, but because relying entirely on one company for something this critical made policymakers deeply uncomfortable, regardless of how well that one company was actually performing. The global space economy was estimated at $400 to $500 billion back in 2023. It's projected to cross $1 trillion by 2030. But remember what we open with. Most of that $1 trillion won't come from rockets themselves. Before we get there, though, one more piece most people skip entirely. Building the satellites themselves isn't free, and it isn't small. A single constellation satellite can cost anywhere from a few $100,000 for a small, mass-produced unit to tens of millions for something larger and more sophisticated. Multiply that by a constellation with thousands of satellites, and the manufacturing bill alone can rival or exceed the entire launch budget that got them up there. This is exactly why the industry leader builds its own satellites on an assembly line. The same philosophy as owning your own rockets. Outsource satellite manufacturing to a third party, and you're paying someone else's markup twice. Once to build the hardware, once to launch it. And the constellation race itself is genuinely competitive now, not a one-company story. A major rival, backed by one of the largest retail companies on Earth, has been building its own competing satellite internet network, chasing the exact same subscription-shaped opportunity when two of the wealthiest companies alive are racing to own the same piece of orbital infrastructure that tells you plainly where everyone agrees the actual money is. It was never really the rockets. It was always what you build once you're up there. It'll come from whatever gets built on top of the access rockets provide. Internet service, data relay, in-orbit servicing, whatever the next subscription-shaped business turns out to be, built on infrastructure that just happens to require an explosion-prone vehicle to get there in the first place. So here's what never makes it into the pitch deck. This isn't really a rocket business. It's an infrastructure business wearing a rocket costume. The rocket gets the headlines, the launch footage, the investor excitement. The actual money increasingly lives one layer up in whatever recurring service that rocket made possible. The operators who survive long-term aren't the ones with the most impressive launch highlight reel. They're the ones who understood early that the rocket was never supposed to be the product. It was always supposed to be the truck. Every other business on this channel eventually finds a stable, repeatable rhythm once the model is proven. This is the one industry where even the companies currently winning are still, in a very real sense, making it up as they go. 20 years into a business that used to only exist inside government budgets. A space company isn't really selling access to orbit. It's selling whatever you can build once you get there, sold to customers on Earth who will never once think about the rocket that put it in the sky. As long as that infrastructure keeps generating revenue every single month, and the launches keep succeeding often enough to keep building on top of it, the math keeps working, one subscription at a time, one mission after another. That's not a flaw hiding underneath the business of owning a space company. That is the business of owning a space company. If you want more breakdowns like this, hit subscribe and let us know in the comments what business you want us to break down next. This one had explosions, bankruptcies, and $1 trillion prize. Not every episode gets all three.